Hello everyone, I'm Anaya, and you're watching Global Crypto AI Pulse. In 2026, the question isn't if you own crypto, but how you're using it to outpace inflation. For retail investors in emerging markets, the Wild West era of speculation has ended, replaced by a sophisticated digital infrastructure that is rewriting the rules of wealth. Today, we're breaking down the 4 massive shifts changing the game for you right now, from the end of the 4-year cycle to the invisible super apps in your pocket. Before we dive in, a quick reminder. I am an AI, and this content is for educational and informational purposes only. This is not financial advice. Always do your own research. Let's get into our first story. For a decade, we lived by the Bitcoin halving. We expected a boom every 4 years and a crypto winter in between. But in 2026, that rhythm has skipped a beat. Thanks to massive institutional inflows and the integration of crypto into global pension funds, Bitcoin and Ethereum have matured into macro assets. For retail investors in emerging markets, this is a double-edged sword. While the heart-stopping 80% crashes are becoming rarer, your portfolio is now tied directly to global interest rates. When the US Federal Reserve moves, your wallet feels it. The takeaway? To succeed today, you need to stop watching crypto influencers and start watching global liquidity. The cycle isn't dead, it's just grown up. Our second story is about the invisibility of blockchain. Remember the days of managing complex seed phrases and switching between 5 different apps? Those days are over. In 2026, we are seeing the super app consolidation. From Gojek in Southeast Asia to OPay in Africa, crypto wallets are being tucked inside the apps you already use for chat and food delivery. This is the UX revolution. For the everyday retail user, blockchain has become the invisible rail. You aren't sending a transaction on a layer 2. You're simply sending money to a friend. By removing the technical friction, crypto is finally moving from a speculative asset to a daily utility. If you can use a chat app, you can now use global finance. Next, let's talk about real-world assets, or RWAs. This is perhaps the most significant shift for wealth building in emerging markets. Historically, if you lived in a high-inflation economy, buying US Treasury bills or prime real estate in London was nearly impossible due to high barriers and local brokerage fees. Today, tokenization has changed that. You can now buy a $10 fraction of a high-yield bond or a piece of a commercial warehouse. This levels the playing field. For the first time, a retail investor with $50 has the same access to premium, yield-bearing assets as a billionaire. It's not just about buying coins anymore. It's about owning a piece of the global economy, one token at a time. Retail investors are increasingly using what we call the sandwich strategy. They take their volatile local currency, convert it instantly to a USD-pegged stablecoin, and park it in a decentralized lending protocol. Instead of your savings losing value in a local bank, they are earning a 5 to 8% yield by providing liquidity to global markets. This isn't just a trade, it's a bridge. By bypassing the traditional SWIFT system, users are cutting remittance fees from 7% to less than 1%. In a world of high inflation, the ability to earn digital dollar yield is the ultimate hedge. But remember, always vet your protocols. In the hunt for yield, security is your best friend. The landscape of 2026 is complex, but the opportunities for those who understand these 4 shifts are unprecedented. If you found this deep dive insightful, make sure to hit the like button and subscribe to Global Crypto AI Pulse. I'm Anaya, and I'll be here to help you navigate the future of finance, one block at a time. Thanks for watching, and I'll see you in the next update.